There's a number almost nobody talks about in polite company. Not because it's complicated, because it's uncomfortable. Right now, the United States government owes more than $34 trillion. That's the headline. That's what gets thrown around on cable news between commercials for reverse mortgages. And most people hear it, nod vaguely, and move on with their day. Because $34 trillion is so large, it stops meaning anything. But here's what they don't show you. That number is growing by roughly $1 trillion every 100 days. Not every year, every 100 days. Which means by the time you finish watching this video, the national debt will have increased by somewhere around $80 million. And you still haven't heard the part that should actually worry you. The debt itself isn't the signal. The debt is just the symptom. The signals, the ones that actually tell you when a debt-laden system is starting to crack, those are buried in language nobody teaches you to read. Yield curves, credit spreads, debt service ratios. Words designed, intentionally or not, to sound boring enough that most people stop paying attention. This video is about paying attention. Not to scare you, not to sell you gold coins or bunkers, but because understanding these signals, really understanding them, is the difference between watching history happen to you and at least knowing it's coming. Let's start at the beginning. Debt, at its core, is borrowed time. When a government borrows money, it's essentially making a promise. Give us resources today, and we'll pay you back later, with interest. That's it. That's the whole machine. And for most of the 20th century, that machine worked pretty cleanly. The US would borrow, grow, generate tax revenue, and service its debts. The economy expanded faster than the debt, which meant the debt as a share of the overall economy stayed manageable. Then a few things happened. 2 major wars, a financial crisis, a pandemic, several rounds of tax cuts, and a persistent political consensus, shared equally by both parties, in case you were hoping for a villain, that spending more than you collect is not just acceptable, but sometimes necessary. By 2000, the debt-to-GDP ratio in the US sat around 55%. By 2010, after the financial crisis and the bailouts, it was 90%. By 2020, after the pandemic stimulus, it crossed 130%. That number, debt as a percentage of GDP, is the first signal most economists watch. And what it tells you is not whether a country can repay its debt in absolute terms, but whether it can grow its way up from under it. At 130%, the math becomes very difficult. Japan, for context, has a debt-to-GDP ratio over 260% and has not collapsed, which is why some people point to Japan and say, see, debt doesn't matter. We'll come back to why that argument is more fragile than it sounds. The second signal is less talked about, but arguably more important. It's called the debt service ratio, and it measures something deceptively simple. What percentage of your income goes just to paying interest on what you already owe? Think about it this way. Imagine you earn $5,000 a month. You have a mortgage, car payments, credit cards, and a personal loan. Now imagine that 800 of that 5,000 every single month goes purely to interest, not paying down the principal, just keeping the creditors from calling. That's 16% of your income, gone before you buy a single grocery. Now imagine that percentage creeping toward 20, then 25. At some point, you're not managing debt anymore. The debt is managing you.
For the U.S. federal government in 2024, net interest payments on the national debt are projected to exceed $870 billion for the year. That's more than the entire defense budget, more than Medicare. For the first time in modern American history, interest on the debt is the single largest line item in the federal budget. Let that sit for a second. The country is spending more on the cost of its past decisions than on its military, its healthcare for the elderly, or its investment in anything new. And here's the mechanism that makes this so insidious. Interest rates were near zero for most of the 2010s, so the government borrowed enormous sums at very low cost. When rates rose, as they did aggressively starting in 2022, all that old cheap debt began rolling over into new expensive debt. It's like having a variable rate mortgage on a house you can never sell, and the rate just doubled. Now we get to the part where the language gets deliberately obscure, which is usually a sign you're getting close to something real. The yield curve. Here's the plain version. The US government borrows money by selling treasury bonds, short-term bonds, 3 months, 1 year, and long-term bonds, 10 years, 30 years. Normally, long-term bonds pay higher interest rates than short-term ones. Makes sense. You're locking your money up for longer, so you expect more in return. When that relationship inverts, when short-term rates are higher than long-term rates, something strange is happening. Investors are essentially saying, I think the future is riskier than the present. I'll take a lower return on a 10-year bond because I'd rather have safety than chase yield in a world I'm not sure about. An inverted yield curve has preceded every U.S. recession since 1955, every single one. The curve inverted in 2022. It stayed inverted for the longest stretch in recorded history, over 700 days. And as of this recording, the inversion has only recently begun to normalize, which sounds like good news. Except historically, the recession doesn't come during the inversion. It comes after it resolves. The inversion is the warning. The resolution is the starting gun.
Third signal, credit spreads. This one is actually my favorite because it reveals something honest about how institutional money thinks versus how it talks in public. When a corporation or a government issues a bond, it pays an interest rate. Safe borrowers, like the U.S. government, pay low rates. Risky borrowers pay high rates. The difference between a risky borrower's rate and a safe borrower's rate is the spread. When spreads are narrow, it means investors are comfortable taking risk. They're not demanding much extra compensation for lending to shakier borrowers. That's usually a sign of confidence or complacency. Sometimes those are the same thing. Sometimes they're dangerously not. When spreads widen suddenly, when investors start demanding significantly more return to hold anything other than the safest assets, it's a sign of fear. Money is moving away from risk. Banks are tightening. Credit is getting more expensive for the businesses that depend on it to survive. In 2008, high-yield credit spreads blew out to over 2,000 basis points. That's 20 percentage points of extra interest just for borrowing money if you weren't considered pristine. That's the sound of a credit market seizing. Today, spreads in many categories remain relatively compressed, which either means everything is fine or that the reckoning hasn't arrived yet. The honest answer is that nobody knows which interpretation is correct until it's too late to matter. Now let's talk about the Japan argument, because you'll hear it constantly as a rebuttal to any concern about sovereign debt. Japan, as mentioned, has a debt-to-GDP ratio exceeding 260%. Japan has not had a debt crisis. Japan's government bond market has not collapsed. Therefore, the argument goes, debt doesn't matter. The U.S. can just keep borrowing forever. Here is what the Japan argument leaves out. Japan finances most of its debt domestically. Japanese households and institutions hold Japanese bonds. The money stays inside the system. Japan also has the Bank of Japan as a buyer of last resort, which has purchased over half of all outstanding Japanese government bonds at various points. The U.S., by contrast, relies heavily on foreign creditors. China, Japan itself, the UK, and oil-exporting nations hold trillions in U.S. treasuries. That relationship is not guaranteed. It's geopolitical, it's strategic, and it has been quietly shifting. Foreign holdings of U.S. treasuries as a share of total debt have been declining for years. China's holdings have dropped from over $1.3 trillion to under $800 billion in the past decade, not because of some dramatic break, just slow, deliberate diversification. When a lender gradually stops buying your debt, the market has to absorb it instead. The market demands higher rates to do so. Higher rates mean higher debt service costs, and the spiral gets harder to exit. Japan also had deflation for most of its lost decades, which meant the real value of its debt stayed contained. The U.S. has had inflation, which complicates the comparison in ways the simple ratio doesn't capture. Japan is a specific case, not a universal proof. So where does this leave us? There's a version of this story where it all works out. The economy grows fast enough. Rates come back down. The debt stabilizes as a share of GDP. Political will emerges to close the fiscal gap. History has surprised optimists before. And there's another version. In that version, the signals we just walked through, the debt-to-GDP trajectory, the rising interest burden, the inverted curve, the spread compression that hasn't yet corrected, those signals converge, not in some sudden catastrophic moment, but gradually. A slow pressure on credit availability, a creeping cost of borrowing for ordinary businesses and consumers, a gradual loss of confidence in long-duration U.S. assets. Not a crash, a grind. The uncomfortable truth about debt crises at the sovereign level is that they almost never look like the movies. There's rarely a single day when everything breaks. There's usually a long, slow recognition, punctuated by moments of sharp panic, that the math stopped working some time ago, and the market is only now starting to believe it. The 2008 crisis didn't begin in September of 2008. The signals were visible in 2006 if you knew how to read them. Most people didn't, not because they were unintelligent, but because the system is designed, structurally, incentively, to reward ignoring them. Analysts who raise alarms too early get mocked. Institutions that hedge too early underperform.
Politicians who tell uncomfortable truths lose elections. The incentives all point towards optimism, right up until they don't. Here's the question I want to leave you with. The signals we've described, the debt service ratio, the yield curve, the credit spreads, the slow withdrawal of foreign creditors, none of them are predictions, they're indicators, patterns that have historically preceded stress without any guarantee that history rhymes on schedule. But there's a deeper question underneath all of it. If a government can always print more money, and technically it can, then why does any of this matter? Why do signals matter if the backstop is unlimited? The answer is that the printing press doesn't create wealth, it redistributes it. Every dollar printed to service debt is a quiet tax on every dollar already held, and at some point the people holding dollars start doing the math. We may already be in the early innings of that calculation. The debt doesn't have to crack the economy to change it. It already is changing it, in interest rates, in housing costs, in the shrinking margin between what people earn and what they can afford. The signal isn't just in the bond market, it's in the way ordinary life has gotten harder to afford, even when the headline numbers say everything is fine. That gap between the official story and a felt experience is maybe the most honest signal of all. And it doesn't require a degree in economics to read.